All right, so bottom line is you're debiting cost of goods sold for $144,000. You're crediting beginning inventory and purchases to close those out. But remember, your cost of goods sold was only $132,000. So in order to reflect that correct amount, you've got to put $12,000 of cost of goods sold into inventory. And so the way you do that is for this entry, your cost of goods sold account shows $144,000. And so you're going to transfer $12,000 to inventory by debiting inventory, and then by crediting cost of goods sold, you've now reduced your cost of goods sold account to $132,000. Now again, some factors suggesting that a company might use a periodic or a perpetual inventory. Perpetual inventory system, large company with professional management, management and employees wanting information about items in inventory and the quantities of specific products that are selling, items in inventory with a high per unit cost, low volume of sales transactions or a computerized accounting system, merchandise stored at multiple locations or in warehouses separate from the sales sites. And you know, more and more companies are able to take advantage of sophisticated software and computer systems so that smaller and smaller companies can actually use the perpetual inventory system. So not necessarily a large company anymore. Factors considering periodic, if it's just a small business, sole proprietorship, you're not going to use a perpetual inventory system. And you can look at the others. I mean, I'm not going to go through them. So either way, it's one of the many judgments that management has to make. Let's talk about credit terms and cash discounts. Now, as I told you not too long ago, most business-to-business sales are made on some sort of credit terms. And so you need to be familiar with the language of credit terms. And so when manufacturers and wholesalers sell their products on account, credit terms are stated on the invoice. And so what we have here are those terms. Here the terms are 2/10, N30. Well, what does that mean? Well, if you ask somebody what are the credit terms, they're going to tell you 210 net 30. Okay, what does that mean? Well, it means there's a percentage discount of 2% that's available for the first 10 days after the sale. Otherwise, the total amount is due in 30 days after the sale. And really, it's date of invoice, not date of sale. Those may actually be two different things. I mean, sometimes it takes a while to actually invoice a sale. Now, you can If you're the purchaser of these items, you could record this at, well, a couple of different ways. You could record it at net cost. Here, if the terms are 2% 10 net 30, Computer City purchases 100 spreadsheet programs for 100 each, so 10,000. From PC Product, credit terms 210 net 30. And so here we're asked to prepare the journal entry for Computer City, the purchaser of the items. And so if we know that we're going to pay the discount, we're going to pay within the 10 days and take the discount, we could just record the cost of the inventory at its net amount that we're going to pay. Recall, or maybe we really haven't discussed this, when you have inventory, especially for merchandisers, you're going to include all costs to get the inventory into selling position. And so, you know, the purchase price is certainly relevant to that. Purchase price of the merchandise. What are some other costs that you might have to add to your inventory to get the inventory in place? Well, you might have to add transportation costs that we'll look at here in a few minutes. You might have to subtract, since it takes away from the cost or reduces the cost, discounts that you take in purchasing inventory. So that's what's happening here. You know you're going to take the discount because it's good business to take purchase discounts. And so you're just going to record your inventory at the net amount. So they record inventory 9,800, accounts payable, PC products 9,800. And of course, when they actually pay it, they debit the accounts payable PC products account and credit cash for 9,800. Note they don't list anything about the sales discount. Now compare that with well, let's see what they're doing here. Oh, okay. Here, what they did was they waited too long. They waited past the 10 days. And so, since they recorded it at net cost, what they're going to have to do is create a, I guess this would be purchase discounts lost is the account I'm talking about. It's a non-operating expense, so it's going to be another expense account called purchase discounts lost, and they're going to debit it for $200. Now they could simply record the purchases at the gross invoice price. This would be another option of $10,000, and if and when they take the discount, simply record the difference between the cash paid of $9,800 and your other credit would be your purchase discounts taken account. And that reduces the cost of goods sold, that purchase discounts taken. Now, of course, if they wait too long and they can't take the discount, they would just pay the full $10,000 amount, and this would be their entry. Now, if you're a merchandiser, you may have returns. And so here, Computer City bought these items, right? So they're the customer. And so this is Computer City's books, not PC Products, the seller. So we're looking at this from the customer's standpoint. If they're returning merchandise to the seller, they're going to, and again, this is recorded originally at net cost, they return basically half of, or excuse me, $500 of unsatisfactory merchandise. Since they recorded the original purchase at net cost, that was $500 times 0.98%, so that's going to be $490. That's the amount they back out of accounts payable, and of course they're going to reduce their inventory by that $490. Now again, remember that if you're the buyer and you incur transportation costs on the purchase, then you're going to add that transportation cost as a part of the asset. And so you're going to book the transportation cost not as transportation expense, but as inventory. And then of course you would credit either accounts payable if it's on credit, or simply cash. And so these are the transactions that are related to the income statement. The sales part, you're going to have sales, and then you're going to have these, what they call contra revenue accounts, called sales, returns, and allowances. Now note here, they kind of flipped on us. Now we're now looking at this from Computer City's standpoint, and they are the seller of these items. Okay? These are not sales, returns, and allowances that they have made to their supplier. This is sales, returns, and allowances that customers have made to Computer City. So these would be, I would think, consumers. Now, the sales discounts part are sales discounts that their customers have made. So it reduces, those two things reduce overall revenue. That's why they're called contra revenue account. Accounts. And so they give a few examples of this. Computer City sold 2,000 of merchandise to Highlander Pub on credit of $210 net 30. Computer City originally paid $1,200 for the merchandise. Because they're on a perpetual inventory system, they make two entries. The first being the accounts receivable, $2,000, and the credit going to sales. And then to record the cost of the sale, they debit cost of goods sold for what it cost them for those two items, $600 a piece, or $1,200 total. Cost of goods sold, and of course they credit inventory. All right, so on November 5th, Highlander Pub returned 1,000 of the unsatisfactory merchandise to Computer City from the November 3rd sale. So here they're going to record into this contra revenue account called sales returns and allowances $1,000 debit. And of course, they're going to credit the Highlander Pub subsidiary accounts receivable account for $1,000, and then they have to put it back in inventory. And so they debit inventory $600 and credit cost of goods sold $600. On November 10, Computer City receives the full amount due, which is $1,000 from Highlander Pub, from the November 3rd sale, less the November 5th return, of course. And so it has the discount in it that they've given to Highlander Pub. So they receive $980 cash. They create another contra revenue account called sales discounts, debit it for $20, and of course their credit's going to be to the AR sub ledger account Highlander Pub. Now, if you are the seller and you incur, not the buyer, remember, if you're the buyer and you recur transportation costs or incur transportation costs, you're going to add it to the cost of the inventory. If you're the seller, you're going to debit delivery expense and credit either accounts payable or cash, because that's going to be an operating expense to you. I don't want to talk about sales taxes. Just realize that sometimes we use special journals rather than the general journal to record routine transactions that occur frequently. Things that happen on a recurring pattern, such as sales and purchases, are usually done in this thing called a sales journal or purchases journal, because your entries for those things are always the same, right? For instance, sales journal, you're always doing AR and sales revenue is your credit. AR, whomever, debit, sales revenue, credit. And so they create these special journals because it's the same thing every time, and all you're doing is recording in the sales journal the day you make the sale, who it's to, and you know that the entry is to AR for that company and credit to revenue. And so you don't even make a debit and credit, you just put one amount there because you know for these sales what the debit and credit is. Okay? So it cleans up a lot of stuff, a lot of recurring stuff, a lot of repetitive stuff from the general journal.